folks. My name is Dave Beattie. I'm the Legislative Compliance Manager at HR Talk. Just very little quick bits about me. Worked at SARS for 6 years in the 90s, and I've worked in the payroll environment for about 30 years, particularly looking at legislation around PAYE, UIF skills, ETR, COID. Today, we are going to focus on travel allowances, company car fringe benefits, and subsistence allowances. I'm just going to show you where the snags are and what you need to do to achieve good practice. First of all, travel allowances. These are under focus of SARS at the moment. SARS are looking to do away with travel allowances and do a reimbursement process. But if you do have travel allowances, it's important that you take into account the following areas. Travel allowance should only be granted to employees if, as a condition of employment, they're required to travel. So it's not given to people because of their position in the organization. It must be as a result of their requirement to travel. That must be in writing in their contract of employment. A travel allowance is granted effectively to finance the employee's business travel cost when using a private vehicle. It's not to cover every travel expense that the employee is going to incur. And remember that the employee uses their private vehicle for private and business. Now, you as an employer have to quantify the amount that is acceptable to give this person to enable them to cover business-related travel. A fixed travel allowance should only be given to those employees who do substantial business travel. What I'm saying there is separate those people who do the odd travel, the sundry travel, give them a reimbursement, and those people that travel regularly for business, give them a fixed travel allowance. It's important to assess the value of this travel allowance. Don't just give the person, as an example, 5,000 and think that that is effective forever. Often we find situations change. The employee starts doing more travel, and they start resenting the employer because the money that the employee has been given to travel is not sufficient. You'll be surprised, not all employees will bring this to your attention, and often it's a straw that broke the camel's back, in a decision to leave the company. The value of the travel allowance should not be sucked out of your thumb. There's a very specific way of calculating a travel allowance, and that is utilizing the cost of the person's vehicle, and SARS have got a set of deemed tables that you can use to calculate. I would be happy to assist you if you want assistance with this calculation, but don't be pressurized into giving an overly large travel allowance to someone because an employee is pushy. A vehicle's title does not have to be in the name of the employee to qualify for a claim for business use. The employee just must be utilizing the vehicle for business purposes. When I say that, the car might be your mother's or your brother's, or you might not be able to finance it in your name, but as long as that's the vehicle, and when you submit your tax return, you're effectively making a declaration that that is the vehicle used in the travel claim. Now, you can't have your brother or your mother and you making a claim in the same vehicle, because SARS will get wise to that. You cannot have a travel allowance for a vehicle that is owned by your employer. You'll be surprised how often people still do that. If the vehicle is owned by your employer, it's a company vehicle, and there's a separate fringe benefit calculation, which we'll look at later. Having use of a company-owned petrol card or being reimbursed for petrol is the same as a fixed travel allowance. So often what happens is you get 5,000 Rand as a travel allowance, and then your employer gives you a petrol card that you can spend 3,000 on in the payroll every month, that should reflect as an 8,000 in travel allowance. So don't be fooled if your employer doesn't give you a fixed travel allowance, but they give you a petrol card, that is not a travel allowance. It is still a travel allowance. Home to work is not business travel. Traveling from home to a client is business travel. Now, this has been complicated significantly by COVID and people working from home. SARS are going to look at where is your regular place of employment. So, for example, me, I generally work out of my home. So, seeing a client from there is business travel. Me driving to my office would be debatable because that's not, well, driving from there is not business travel because that's not really my place of employment anymore. SARS would look to see that you have split the business and the private elements sufficiently as to which part of that trip is private. So from your home to work, as I said, would be private. But if you're going to go from home to a client because your office is not your home, that would be business. Very importantly, if you have a travel allowance, you have an obligation to submit a tax return. You cannot not submit it, because remember, the travel allowance is taxed at, or 80% or 20% of it is taxed. The balance is taxed on assessments unless you submit a travel claim. So we often see people sending us messages from their employees saying, "Oh, you people have messed up this employee's tax. They owe 5,000 Rand on assessment." And when I look, they've got a travel allowance, or they've got 3702 reimbursements above the SARS rates on their IRP5, but they haven't put in any claim, any logbook claim. You're going to owe money. Also remember, you can only tax 80 or 20. You can't tax 100% of a travel allowance anymore. There's no point in taxing it at 100%. If you're taxing it at 100%, you're effectively saying this person isn't required to travel for business. So don't give it to them at all. Travel allowances must not be disproportionate to your other packages in your cost of company. I generally look at it I generally look at the cash elements of the cost of company when I look to see if a travel allowance is proportionate. And I look at 35% of the employee's gross cash pay as being the maximum that a travel allowance should be. Just remember that if you're earning a too big a travel allowance, SARS are going to look at you and say, you don't work for a travel allowance. A travel allowance is given to you in addition to what your pay for work is to do work for the employer. So when they see things like a 20,000 Rand cash pay and there's a 12,000 Rand travel allowance and only 8,000 Rand basic pay, you are going to get an audit because that just doesn't make sense at all. So use the 35%, but I advise you to go the more mathematical route and actually do a calculation to see what's most appropriate, and then apply the 35% if your calculation is more than that. Going back to the 80% story, if the employee is traveling less than 80% for business purposes, you're going to tax 80% of the travel allowance monthly. But if the employee is a rep or someone that sees clients every day and is on the road every day, and more than 80% is going to be business travel, then only 20% is taxed monthly. That just saves the employee from being out of pocket until they submit their tax return. But remember, it all comes out in the wash when you submit your tax return. SARS are going to do a recalculation. And I don't know about you, but I prefer to get my nice refund on assessments and not owe SARS on assessments. And sorry, in my notes, I've just included again, you can only tax 20 or 80%. There was a BRS change in 2019. So just to close off on the company, on the travel allowance issue, very important to have the travel allowance requirements in writing on the employee's contracts. Okay, SARS have been known to disallow travel allowance or travel claims because it's not on the contract. So if that person is traveling for business purposes, it's very simple to put a line in and just say something to the effect, you are provided a travel allowance which will be reviewed annually based on the amount of mileage that you're doing for business purposes. It's something similar to that. It doesn't need to be anything massively complicated, but that's just showing that there is this contractual requirements. And then, as I said, it's a very good idea to actually calculate the travel allowance. And if you've attended my annual webinars, annual legislative updates webinars, and previous travel allowance webinars, you would have seen how the SARS tables change every year depending on your fixed cost. It allocates fixed cost petrol maintenance, and it puts your vehicles into brackets. So you can see the fixed cost for a vehicle of, for example, 250,000, and you can see what the fuel cost per kilometer and the maintenance cost per kilometer is. So if you do that type of calculation and you've got it on file, you'd be showing SARS that you're actually doing this correctly. What you mustn't do, and if there's anything you must learn out of this webinar, it's do not allocate travel allowances based on the seniority of employees. SARS are going to ask you the basis on which you allocate the travel allowance. And if you say, well, employees above level 4 all get travel allowances, and they tell us how much they want, you're going to get an in-depth audit. I can promise you that now. So don't do that. Tell SARS the right story, and I'm pretty sure you'll be happy. And then, as I said in the very beginning, we're hanging on for dear life with travel allowances. It's the only structuring element of a salary left. SARS are looking to do away with it, but they have been for 3 years. So we're not quite sure what's going to happen. I think they can't find a suitable approach, but it's probably going to have something to do with the travel reimbursement. And then it would be interesting to see how the situation for each employee changes. Because that employee is telling SARS that they're doing 25,000 Ks business travel a year, but the next year they're only getting reimbursed for 2,500. That tells you that there's some sort of manipulation or fraud happening, and you could end up having an audit. Moving on to company car fringe benefits. This is also something that's very badly dealt with at employers. As an ex-SARS auditor, the first thing we used to look at is the company's fixed asset register, and we would identify vehicles. And then we would go through the vehicles, allocating the responsibility of that vehicle. So, for example, we see that the company's got bakkies driving around. You can see the bakkies that are being used for delivery, but you can see the better vehicles also on there. So the question is then asked is, who are the designated drivers of these vehicles? And then, then things start getting a bit touchy because people are scared to say who that is. Because once we know once SARS knows who the driver is, they're going to go to the payslip and see whether there's a fringe benefit. So You, you need, if SARS are at your organization, that they're only talking to certain people. What we used to do is we used to just ask the PA or someone when when the manager wasn't there, whose vehicle is that? And then generally those people would tell the truth, and then you would find out that half your senior managers are using company cars, take them home, use them on weekends, and are not paying fringe benefit tax. So yeah, just be very careful. So company cars, obviously a taxable fringe benefit is applicable if an employee has right of use of that vehicle. How is that fringe benefit calculated? Well, pretty simple. The vehicle will have a determined value, and we've had a long traumatic history of the determination of what determined value is. But the legislation changed in 2015, and I would think that most vehicles acquired before that are no longer on the asset register and have gone. So, in a nutshell, we're looking at market value and multiplied by a factor of either 3.25% if the vehicle has a maintenance plan, or 3.5% if it doesn't. So for example, if the vehicle is 100,000 and it's got a maintenance plan, 3,250 rand would be the calculation here. Now your employer, like with travel allowance, has to determine whether 80 or 20% of that must be taxed. So if the vehicle is used more than 80% for business purposes, then you would apply 20, you would times 20% to that 3,250. And if the vehicle is used, say, 50-50 between business and private, then 80% would be taxed. So it's important that the employer do their homework there and get buy-in by the employee, because, as I said before, when you submit your tax return, you can be in for a nasty surprise if your employer has tried to be kind to you and reduce your tax on a monthly basis and only included 20% of the fringe benefit, because you might only be traveling 20% for business purposes. And now, when you hand in your tax return with your logbook, you're going to have a serious problem in that you're going to owe, there's going to be a tax shortfall. So my advice to you is every year you relook at this like you do the value of a travel allowance. Going back to that determined value, so the actual market value, including VAT, but very important, it must exclude finance charges and interest. If you get this wrong, you can be doing the employee disservice. You can be inflating the fringe benefit value. So just be careful with your calculation. Just to repeat it, it's the actual retail market value. So the price that you pay at an arm's length transaction. So I mean, if you go to your local Ford dealership and you buy a new bakkie, they're gonna give an invoice with this retail market value, plus they're gonna add VAT, and then if it's financed, you're gonna have finance charges. So yeah, just be careful of that. You also, quite common these days, is vehicles acquired under an operating lease. Now remember, if they're acquired under an operating lease, you haven't purchased them. They're also not on your asset register, on your fixed asset register as a balance sheet asset. So you are effectively renting the vehicle on a monthly basis. So the fringe benefit calculation there is the rental and the fuel cost of that vehicle to that employee monthly. See lots of challenges in the marketplace there. People do not know the difference, or they don't ask the right questions, and then these calculations are wrong. Okay, so just a little example. What I've done is I've said company buys a vehicle with no maintenance plan for 280,000, inclusive of that. The vehicle is used by the sales rep, and he is going to use it privately. What would the monthly fringe benefit be? So the determined value is the value, market value, including VAT. So we know that 280,000 is the starting point. Now, an important declaration has been made here. There's no maintenance plan. So we now know we have to use a 3.5% inclusion. And in the question, well, in the scenario that we're looking at, the vehicle is used equally for business and private purposes. So remember, I said to you, if the vehicle is used less than 80% for business purposes, we have to tax 80%. So in this case, it's used 50-50. So the calculation is pretty simple. It's the 280,000 times 3.5% times 80%. The fringe benefit then is 7,840. And if the vehicle were to have a maintenance plan, we would substitute the 3.25 for the 3.5, and the fringe benefit would be 7,280. Now that's the value that is going to go into the employee's taxable income on a monthly basis. So that employee, if they're in the 41% tax brackets, for the pleasure of having a vehicle with no maintenance plan, is going to pay tax of 41% on the 7,840. Pretty simple calculation, but a calculation that you need to get right in the beginning, because once it's in payroll, it will be there for a long time. Importantly, noting that the vehicle fringe benefit determined value does not change if the employee uses that same vehicle for 20 years. I know people get frustrated with that. They say, oh no, but this Ford double cab is a wreck now, and he's had it for 20 years. The legislation, unfortunately, doesn't provide for any reduction in value. The only time you can depreciate that vehicle is if that vehicle changes hands. So as an example, if an employee gets given use of that vehicle, okay, and it is more than 12 months from the date of the original purchase. So for example, employee A has the vehicle for 14 months, okay? He's had it for 12 months and he gives it to employee B. Employee B the vehicle can be depreciated by 15% for each completed 12-month period. So obviously, if the person's only had it for 14 months, there's only one completed 12-month period. So employee B is going to pay fringe benefit tax, okay, with a vehicle of a determined value of the original value less 15%. Now, let's just look at another example. Employee A, in this case, had a employer-provided vehicle. He utilized it for 30 months. Okay. The vehicle was purchased for 200,000, including VAT. Now, what does the 30 months tell you? The 30 months tells you that there's two periods of 12 months, completed 12 months in that. It's not 36 months where it would become 3. You've had it 12 months, 24 months, and now you're at 30. So you can only depreciate that vehicle for 15% for 2 years. So as an example, in year 1, you would work out what 15% of the original purchase price was, which was 200,000. That is 30,000. Okay. So in year one, the vehicle is depreciated by 30,000. And then in year two, you would go 170,000 times 15% is 25,500. So the total depreciation on this vehicle after 2 years is 55,500. So when employee two comes to utilize this vehicle, he can't pay fringe benefit tax on a 200,000 rand vehicle. He can only pay fringe benefit tax on a 200,000 less 55,500 rand vehicle. So the fringe benefit value will be 144,500. So you can see the depreciation is on a reducing balance method for those people who are accountants. Just to repeat, it's only 24 months, because only 24 months is the two completed 12-month cycles. If you'd worked for 36 months, you would have been able to depreciate it 3 times, utilizing that 15% on a reducing balance method. Fringe benefit rule. Be very careful when you decide if any of these points are applicable, because you will be responsible to SARS. If the vehicle is available and used by other employees, so this is an old trick. You know, you go to an employer and they say, well, yes, all of our cars are pool cars. They've got a nice little policy. And then it's up to you as the SARS auditor to disprove that. So, I mean, if I was there for 5 weeks on an audit and I only saw the same person driving that car and there was no sign out register, as an example, I would dispute that that was a pool vehicle. The second point is if private use is infrequent. So, if you have a policy that says you have to keep an accurate logbook and we've got you on tracker, and you can prove to SARS that you literally only utilize that vehicle for business purposes, then there wouldn't be a fringe benefit. But you are going to be challenged, and I don't like to go that route because you're poking the bear. The vehicle is not usually kept at or near the employee's residence or outside of business hours. Quite a common thing. The employees, as a perk, are allowed to take the vehicle home. You're going to have a real problem proving to SARS that that's not a fringe benefit and that the fringe benefit calculation shouldn't apply. If the employee's duties require the person only take that vehicle for call-outs, so this is quite common in industry, whoever's on call that week takes the vehicle home because it's not practical to drive your personal car to the factory at 2 in the morning and then go see the breakdown, as an example. So if you've got a policy like that and it's clear that it's working, then there wouldn't be fringe benefit tax. So, and then also if the employee is not allowed to use it for private purposes. But also, I don't like that one, because telling SARS that, yes, I promise you, we've told the employees they're not allowed to use it for private purposes, is going to go down like a lead balloon with SARS. So to summarize, you need to get the determined value correct. So when a vehicle comes into your organization, demand that purchase agreement, look at it. Market value, including VAT. Same as a travel allowance. Actually, SARS are going to ask for that document, proof of purchase. You must have it available. Second of all, which percent must I apply? 3.25 or 3.5? Well, it depends if there's a maintenance plan. And then do I apply 80% or 20%? Well, you sit down with the employee and based on their circumstances for that year, you determine which is the most applicable. And then familiarize yourself. If vehicles are changed regularly, so the MD uses a vehicle for 3 years and then it gets handed down to the ops manager and then the site supervisor, you would be able to prove that you can depreciate that vehicle. The The other thing with the company car that I just want to leave you with is often company cars are sold to employees or included as some sort of a remuneration to an employee when they leave the organization. The market value is still critical because if you are given a vehicle by your employer for no consideration, so for free, your employer has an obligation to get a valuation on that vehicle. Now, there's many ways of skinning a cat. But what I normally what I normally suggest is that you go and get 3 or 4 quotes, and then you take the cheapest two and apply those. And if SARS asks, did you get quotes? Yeah, here they are. We applied the average. So yeah, it's just a way of obviously the vehicle of the employee paying less fringe benefit tax on termination. But you as the employer have got an obligation to do that. If you don't do that, you depends on how mean the audit is. Yeah, maintenance plan, service plan are the same things. Moving on to subsistence allowances, been a couple of changes. Well, change in application here as of 2021. So a subsistence allowance is effectively given to an employee to cover certain costs when they're away from their normal place of residence for business purposes. So we're going to look at a couple of scenarios. The original legislation said you had to be away at least one night, but now we've got a reimbursement process that is applicable. The same incidental cost rate is applied, but I'll go through that shortly. For the 2026 tax year, if your employer pays you for incidental costs per day, they can pay you 176 Rand without acquiring tax. And if it's meals and incidentals, it's 570 Rand. That changes every year. So just going back to that scenario, your employer sends you to Port Shepstone for the day, and that means you're on the road the whole day. You can spend and be reimbursed up to 176 Rand without your employer having to tax that. It's not an allowance, it's a reimbursement. That wasn't previously applicable because remember the legislation said you had to be away overnight. We've also got subsistence rates that apply to overseas travel. That has changed yearly. I know 1 year it wasn't changed. I think it wasn't changed for 3 years. But yeah, if you ever need that, it's on the SARS website, or you can contact me. So if you're going to send an employee to Azerbaijan, as an example, you would go to that schedule and you would look what currency is applicable in terms of the allowance, and they might say US dollars. And just as an example, they might say it's $150 a day you can give tax-free. And then that would change for every single country. So some countries are more expensive than others. So, I mean, I know Angola is a very expensive country, and Switzerland is expensive. So if you're going to Switzerland, the rates that SARS allows us, subsistence allowance, is probably significantly higher than France, as an example. Okay, the next slide, I've covered the day trips. Okay, as with travel allowances, it's quite important that if you are going to work on a subsistence basis, that you put a clause in employment contracts. And I've proposed 2 different type clauses. The first one is you're required to spend some time away from home traveling for business purposes. The company will pay for your accommodation, which is a SARS given. The employer should always pay for the accommodation or reimburse the accommodation. All receipts, okay, must be retained for meals and incidentals and hand it into your employer within X number of days, and you do a reimbursement process. I always suggest that you put limitations on everything, because if you tell an employee just bring back receipts, they're going to be eating seafood platters every single night. The other option is to put a clause in and say, listen, we reimburse at the SARS rates. You will receive 570 Rand per day from meals and incidentals. Then they don't have to keep receipts. So that's obviously the easiest route. So I think it depends on the type of your business, and how often people are traveling and where they're traveling, what suits you. I mean, a lot of employers might say, look, we just give a credit card to cover business expenses, and that will be reviewed for um, acceptability by the employer. If there's no clear subsistence policy, you're going to have problems with employees. The give a hand, they take the arm mentality. It's important that people know what the boundaries are. So, just as an example, I require you to go to Joburg for the night. I've booked you into Sanson Sun, and that covers all your meals. They are covered. Okay, that's fine. So I don't have to give you anything. Okay, or I booked you into Sanson Sun. You can spend 500 Rand a day on meals. Just bring back the slips. Or your employer doesn't want the drama. They just say, listen, I've paid for you to stay at Santon's Sun, and I'm going to pay you 570 a day. You deal with it as what you may. So you might want to stay with a family member, etc. There's no justification to SARS, so you don't care. So the tax treatment, obviously, all the slips and incidentals, SARS are going to just check that the person's put all the slips neatly into a schedule. It's signed off by management and it looks reasonable. There's no tax implication. Scenario 2, you give the person a subsistence allowance at the SARS rate. Your employer has to report that in the payroll. There'll be no tax implication though. And then scenario 3, you give a subsistence allowance which is above the SARS rate. SARS will still report it in the payroll. The employer will still report it in the payroll, but there might be there will be a requirement on assessment to prove to SARS that you've spent more than the SARS rate. Otherwise, you will owe money. So that third scenario is a very, very common reason I get queries. You've messed up my employees' tax. Why do they owe SARS? And when I look, the employer is paying them over the SARS rate, and they're not justifying the expense on their tax return. So SARS say, without the justification, we're just taxing this. Subsistence codes. If the SARS rate is exceeded, we use code 3704. As I said to you right now, that can create challenges for the employee. So unless you are massively exceeding, I would suggest going the SARS route, because then there's no onus on the employee to justify the expense, and you'll be shocked how little taxpayers know. So yeah, don't put them in a situation where they have to keep slips and justify. It's just creating a problem. So if you go at the SAR or below the SARS rate, you'll use code 3714, which is a non-taxable code. And then obviously there's codes for foreign travel, which you can look at in any SARS guide. Just a couple of other rules on subsistence allowances. You cannot factor in a subsistence allowance into an employee's package. So you cannot say, I think you're going to be in Joburg 2 days a month. So here's 2,000 Rand as part of your package. It doesn't work like that. You have to give the employee the subsistence allowance in the month that they travel. If they haven't traveled within the next month, then you have to tax it, or the employee would have to repay it. And a fixed subsistence allowance cannot be paid to an employee who's required to relocate. Now, going to Joburg for a week or two to do a little project is one thing. Having to move to Joburg is another thing. So you can't give someone a permanent subsistence allowance because they have required to move. Relocation expenses is a completely separate section of the legislation, which I will cover at some other stage. Like that's that. I just want to look in the questions quickly. If you just bear with me. The question is, what's considered incidentals? So incidentals is anything that you're unlikely to get a voucher for. Car guards, parking meters, anything that is not. Okay, so food is in the one element of your subsistence. Incidentals is another. But as I said to you, if you're going to send the guys down the coast or away for the day, incidentals would include if they spent any money getting a burger, chips, etc. Okay, sorry, I'm just seeing the Veshni. So the guys travel for 2 nights at a time. The accommodation is paid by the company, and they are given daily living out allowances. Okay. Is the 176 daily fair? If it was to cover meals, I would say no. Remember, you can go up to that 570 Rand per day. So if the guys are going to go away, remember you're talking, unless they're at a B&B, breakfast, lunch, and dinner. So yeah, I would look more at the 350, 400 Rand mark. To be fair, it would still be tax free, but that's up to your company, and company policy. The next question is, on a lease car, can you use the fuel usage for tax? Can you use the fuel usage for taxation monthly? Yes. So obviously the person the company is leasing the car, they're giving it to you as the ops manager. On a monthly basis, they have to say, well, the lease is 4 grand and you've spent 3.5 grand on petrol this month. You must pay fringe benefit tax on 7.5. So that's how that would work. What a lot of employers do is, because the fuel comes through later than the payroll, you're always running a month in arrears. But SARS don't have a problem with that because that's a practical consideration. Next question from Vicky is, company car value. Where would someone find the retail market value of a very old car, a 1998 model? Can we make use of the book value? Vicky, is that vehicle, if that vehicle is on the asset register, there's going to be a book value. Technically, you can't use that book value. You should be using the value that you paid for it. If you don't have that slip anymore or that contract, I would make use of good old Google and try and find a value. A difficult one. My concern would be why it hasn't been in the fringe benefit calculation all this time, but we don't want to go there. Stephanie says, how do employees treat the 100% taxable allowance if it's part of their cost of company package, if the 100% taxable allowance falls away? Most payroll systems won't allow you, Stephanie, to tax something at 100%. So you have to have a look at this and say, why are you taxing this at 100%? If the person doesn't use the vehicle for business purposes, you're going to have to call this some sort of other allowance and tax it. So code 3713, other allowance, 100% taxable. That will stay in their cost to company. But yeah, SARS are not, well, SARS were not happy with the fact that people were deviating from the 20 or the 80% factor, and that's why they did away with the 100%. So you're gonna have to call it something else, but if you call it something else, the employee can't claim any deduction. That's all I see. Okay, so yeah, there's some in the chats. I've covered the service plan thing. Okay, so the question is, are there restrictions on what is covered under subsistence? Specifically, is alcohol? I've never seen anything in all my years that would stop. I know when I worked at SARS, we weren't allowed to spend on alcohol, but we, being the clever auditors that we are, we got them to call them milkshakes or something, when we traveled. But there's not. It's just meals and incidentals. So you've got the 570 for the meals, 176 for incidentals. I don't think there's a prescription. The next question is, do you have to run the S&T through the payroll if it's at the SARS rate? Yes, you do. There's specific codes for subsistence, whether it's at or under or over. So yes, you have to. If SARS came and did an audit, they're gonna make that a finding. And the way I used to look at things is basically the less findings I see in the first couple of days, the more I know that you're in control, and the less inclined I am to stay. So bear that in mind. Anyway, folks, that's that. I've gone over the 40 minutes. Sorry, I do talk too much. Candice will, Charlene will send you a recording of this webinar, and she'll explain the process of doing the exam. That sounds ominous. Anyway, good luck. I hope you've learned something, and please, log in on a Wednesday. We have all sorts of interesting topics that we discuss for your benefit. Have a lovely day. Bye.